I've officially been investing my money in the same way for 2 full years now. Now, depending on who you are watching this, you might think that sounds like a long time, you might think that sounds like nothing. I think it's all about perspective, and from my perspective, as someone who is planning on investing for the next several decades, 2 years actually isn't very long. But I'm still really excited about how consistent I've been, and it's still really fun to look in and see how my portfolio is performing in the short term. So for a quick recap on me, I'm 26 years old. My goal is to invest consistently, to grow my income as much as possible so that I have more money to invest, and then also to set myself up to grow my personal net worth as much as possible through long-term investments. Now, for now and for the last 2 years, I've been using a Robo-Advisor to invest. So basically, I just picked a platform, I created a profile, I picked my investment account, and then I fund that account with money every single month. And then the Robo-Advisor actually picks and buys funds for me, so I kind of get to skip that step. Something that I think is really important is to just get started and then to learn more and grow your confidence with money over time. Like, I know a lot more about my portfolio and what I want from my investments now than I did 2 years ago. And hopefully 2 years into the future, I'll know even more than I know right now. So how I actually go about investing actually might change because I'm always learning more, but what I'm investing in, which is passive funds that track the market, that's still always going to be my foundation. Okay, so let's also talk about what I invest. I've been consistently putting $1,000 per month into my investment account for the last 2 years. And this year I'm actually hoping to up that to $2,000 a month instead, starting in March. Now, you guys might already know that Dennis and I work for ourselves, and we've recently figured out that we are able to increase our monthly take-home pay, what we consistently pay ourselves every single month. And my plan is to put all of that additional money into my investment account too. Now, with that, which is really exciting because I'm doubling my monthly contributions into my investments, it also means that my other investing goal for the year is to hopefully max out my TFSA. It'll be a combination of having that $2,000 per month now and also hopefully investing another chunk of money at the end of the year like we were able to do this past December. So 2 big investing goals hit for the year. Okay, so before I run over to the desk and take you into my actual investment account and show you everything that's going on in there, I just checked and I wanted to say that last year when I did this video, I had contributed $16,000 to my account. And this year I have over $33,000 contributed, which means that I've doubled it in the 1 year, which is really exciting. I'm really happy about that. And this year, if I hit my goal of maxing out my TFSA, that would make me really happy too. Okay, so now let's go on to the fun stuff. Okay, so this is my Wealthsimple account. You can see right at the top that I have $34,756 in here right now, which is both what I've contributed and how much the account's up right now, about $1,700. But I want to take you right into my TFSA account, which is the only account that I have here. So when we click in here, we can actually see again my total value and what my return is, and it's 5.3%. This obviously goes up and down every single day. It changes slightly, but today it's at 5.3% overall return. So how much my account has grown in value based on what I've added into it. Now you can kind of see this little graph here on what it predicts you'll have in the future, but I want to take us right into the history instead because I really like looking at this chart. So a few things to note here. Again, you can actually see what I've deposited in here. So $33,000. I think the $5 specifically is a little bonus that Wealthsimple gave out for just using their account. So that was cool to add in there. That's where the $5 comes from. Again, what my return is as of today, and then the return rate. Now back up to the chart, because this is what I think is really interesting to look at and also kind of shows a little lesson on what's been happening over the last few years with the returns. You can see that my account value was above my deposits pretty early on, starting around there, consistently, pretty much all of 2021. So the last time I did this video, my account was growing consistently. Every time I added money in, I got a return on that investment every time I looked into my account. So you can see, right, the account value line above the net deposits line all the way through 2021. But this past year in 2022, that started to change around, I think here for the first time, around February and March. It kind of went up and down for a bit, and then you can kind of see that gray line overtake the yellow one for almost all of 2022. Now, this is really similar to what was going on in the overall market too. So if we look for a second at the S&P 500. So again, if you look at this chart of the S&P 500, I pulled it up so you can see the long view, but we just want to look at the last 2 years specifically. 2021 was obviously this crazy high tear, right? It's just super going upwards. You can totally see the trending upwards line. And then it hits that peak around the same timeline, early 2022, and then just starts going down from there. Obviously a lot more volatile in 2022. You see these big ups and downs, but for the most part, it's definitely trending downwards, just like my account was. And then we see where that all changes again around October, November of 2022. It starts slowly making its way back up into this year. Now, I'm not invested in the S&P 500 specifically, right? In a second, I'm going to open up my holdings so you can see what funds I'm invested in and what indexes they track, but you can still see that similar trend here. Now, I think this is really interesting to talk about as someone who's only had this account for 2 years now, so fairly short term, but I've been able to see a big difference between those 2 years. Like last year, again, when I did this video and my first year with this account, it looked great, right? Every time I looked in, even if these lines look really close together, you can still see that my account value was growing more than my contributions fairly consistently and evenly. So it just feels good as a new investor to know that your money is growing. And then 2022, I had to deal with the exact opposite where I was down in my money every single month. Now, what's interesting about this too is that I got to learn the lesson firsthand, and that I already know this lesson, but really getting to see it with your own money is a different impact, I think. And that's that you only actually lose money when you sell, especially when you're a long-term investor, right? If I decided to panic and freak out that my account value was down every single month, I would have lost money because I would have been selling at a loss. But I held on to my investments like I'm planning to do as a long-term investor, and then less than 12 months later, it flipped back and I'm growing my money again. And I'm going to see this happen many times over several decades long of investing. Okay, so now let's look at my actual portfolio holdings. So here you can see 100% equity portfolio. This is actually my first full year, my first full 12 months where I've had my risk level at the max that it can be, which is an 11 out of 10 or 100% equities. So basically all of my funds hold just stocks and equities, no bonds, no other fixed income investments. So it's actually cool to see also how the performance has changed just with this type of portfolio. So let's look at what that means for my holdings. Right here, you can see that I have 33.5% of my portfolio in US equities. This is specifically 2 different funds, VTI, which is the total US stock market, and also QUU, which is specifically for large cap equity index funds. So that's the US equities, a third of my portfolio, the biggest chunk as well. Then we also have international equities, 24.5% of my portfolio is in this, specifically a fund called ZEA, and it tracks this index right here. Now, for these international equities, what it actually holds inside of it is tracking the performance of large and mid-cap companies from developed markets that doesn't include the US and Canada. So how they define developed markets is around Europe, some countries in the Middle East, also the specific, so think like Japan, Australia, and some other countries there, but not the US and Canada, since you can see I already have those separately. Next up is emerging market equities, which is 16.8% of my portfolio. I specifically hold one fund that covers this, which is EEMV, and this one tracks the MSCI Emerging Markets Index. So again, you can see the pattern there. In this case, it specifically tracks the performance of large and mid-cap companies again, but for 24 emerging countries. So in this case, they define emerging countries as like China, India, Brazil, and then a bunch of other ones, obviously, to make up that 24 group. Then there's global equities. Now at this point, it's obviously starting to seem maybe repetitive, but I'll give you what the difference is here. Global equities is 12.5% of my portfolio. Specifically, I hold a fund called GLOV. Now this one's brand new. It only was created in March of last year. So last year when I did this video, I would have held a different fund. Again, the Robo-Advisor picks these out and would have swapped in this one for me at some point during the year. Now this one specifically tracks these big stable companies that have low volatility, and again, global companies. So think like Walmart, Apple, Microsoft, Johnson & Johnson, a bunch of big stable companies like that. And finally, the smallest holding that I have here is my Canadian equities at 12.4%. This one specifically is QCN, and this fund basically just holds just Canadian companies, right? So think like big banks is some of the biggest holdings. There's a bunch of bigger banks on there. There's also some of the more famous Canadian companies like Shopify, Brookfield's on there as well. So that's what's in that fund specifically. The last thing I wanted to mention too, I mentioned it really quickly before, but again, I didn't pick these 6 funds out, right? This is all specific to the Robo-Advisor, like how they swapped out for GLOV at some point during last year. So I don't actually have any say or control in what funds get picked or even the allocation. I just picked my risk level of the 100% equities, and then they do the work from there. Now I actually want to talk about that point a little bit more, but let's go back to the couch and be a little more comfortable when we do it. All right, so I touched on this earlier, but I wanted to talk a little bit more about it. And that's that as I've learned more about my portfolio and about investing in general over time, I realized that maybe I actually want to be able to pick the funds that I'm investing in. So I'm going to explain that a little bit better so it makes sense. What's been really great about the Robo-Advisor for me is that I didn't have to pick out which multiple funds to invest in, right? Like I landed on 6 different funds. Instead of having to decide what those 6 are, I just knew that I wanted to invest in passive funds that track the market. So the Robo-Advisor actually picked them for me, and that was really helpful at first. Then over time, I realized as I grew my confidence with money too, that I wanted to increase my risk level because I'm young and I have time to ride out the ups and downs in the market, right? So what was cool is I was able to do that with this account. I could make my risk level all the way up to 100% equities. And I did that about a year ago now. Now I'm at the point where I'm realizing that the actual funds, those 6 funds that the Robo-Advisor chose for me, maybe those aren't the exact funds that I would choose for myself if I was buying them all individually. Now, there's a few different reasons for that too. One is that the global diversification is a little high for me personally. It doesn't mean it's high for everyone, but myself, maybe I'd want a little bit more percentage in the United States instead. So something for me to think about in the future. I do still see me sticking with the Robo-Advisor for the foreseeable future because I just am not prioritizing my time on doing that myself at the moment, and it is really helpful. It's comfortable for me too. I really like using it, but it's something that I could see myself changing up how I invest in the future. I might revisit it after I max out my TFSA, so stay tuned for that. Also, on that note, really quick, because we usually get questions about this, once I max out my TFSA, I'll actually still have room to contribute to it every single year. Like this year, the room limit increased by $6,500, and every year there's a different amount that it increases by as well. So for me, I would be prioritizing re-maxing it out every single year as the room grows by that $6,000 or whatever it is for that specific year. Now, after that, I'd have to move on to a different investment account to invest in as well. In Canada, there's the RRSP. There's also a new registered investment account that's coming out later this year that we're going to be talking about really soon too. And there's also always a personal or taxable account. The only thing about that is you'd have to pay taxes on that money as well. So you have options after you're done maxing out your TFSA. If you want to hear more about Dennis's investments, then you'll see that video next week. And in the meantime, check out this video about how I stopped being scared of money and how you can stop being scared too.